Hey everyone, welcome to the second video of the audit quiz walkthrough where we go through module 2. And just to reiterate what we went through in the first video, just to explain the purpose of these series is not to go through all of the questions, nor is it to just give you the answer, but we really want to just explain how to approach it, how to use the notes to get there. Here's some examples, here's the thought process, how to use deduction to get the correct answer. And then using that skill set from this video, you go and then practice the remaining questions in your own time. So we've got a lot of questions for you to practice. In this case, over 100 questions for you to practice. The more you do, the better you're going to get. And if you can get all of these right for module 2 and module 1, and once we go through all of the modules as well, you should be ready for your final exam. Because your final exam should be closely resembling these types of questions. So it's also about practicing and doing in a timed environment, doing under pressure, and maybe doing it with printed notes as well, and maybe tabulating the key areas that you regularly use. Okay, so let's get started with question 1. So which of the following terms best describes the type of control evidenced by a segregation of duties between computer programmers and computer operators? Is it A, application control, B, system software control, C, organizational and management control, or D, systems development and program management control? So this is a form of general control. So a general control is something that's not specific. A specific control could be specific to an application, could be specific to a certain process, could be specific to even a type of person or their role in the organization. Whereas general control is something that applies to a wider berth of the organization, whether that's, for example, all software, whether it's all systems, whether it's to do with the management hierarchy and structure of the organization, separation of duties. That's something that applies to multiple areas of the business and is more about the conceptual, high-level strategic way of preventing fraud and misstatement rather than specific to a program or process. So the options that are given us are application, system software, organizational management control, systems development, and program maintenance control. And we want to know which one reflects segregation of duties between computer programmers and computer operators, i.e. the ones writing the program and the ones using the program. Because I guess potentially if the programmer is the one using the program, he knows all the ways around it, so it doesn't really prevent fraud. For example, if he's doing the payroll, so he designs the payroll and he uses the payroll, he could create a workaround so that no one potentially knows about him creating fraudulent employees and then paying those fraudulent employees, right? He could cover that up. So what I would do is I'd bring up the notes in the relevant section talking about general controls, and you can just do a Control F on general controls. So that will bring you to this diagram here, which talks about general controls. It visualizes the different breakups of where they can fit. So for example, they can be organizational and management controls, which is to do with the structure of the organization and segregation of duties and policies for doing those duties. Then you've got system and development and program maintenance controls, like who can actually maintain it, when it's maintained, ensuring the maintenance make sure any changes ensures the program is still compliant with standards and requirements. Then you've got computer operation controls, which prevent certain things from happening, like, for example, backing up and recovering or activity logging, so we know what's going on, so that everything is safe, what's our problem to deal with, our resolution dispute and problem mechanisms. Then you've got system software controls, which is things like, for example, I mentioned before, when you put in a credit card form, you can only put in numbers and they must follow a certain structure. That ensures we know it's a valid credit card. And then finally, data entry and program controls, which ensures valid and authorized input by restricting access. So this is like, fingerprints and access cards, or physical controls, right? So prevent only certain people can access certain restricted information or controls and things like that. So which one of those do you think fits in here? And remember, we're trying to keep in mind it's a general control. So if it's to do with hierarchy, which is clearly what's happening here, segregation of duties, we mentioned before that fits in this one up here, organizational and management controls. So it's most likely going to be C here, but let's also figure out why it's not A, B, and D. So A, application control. We talked about this previously, but an application control is not a general control. It's something that applies specifically to a particular program. For example, in the payroll software only, maybe there's a restriction that you can't have sick leave if you have a casual employee in there. That would be application specific. Next is system software control. And that was also in this diagram of general controls that we talked about. And that's talking about, ensuring ensuring that validity of input and access, for example, passwords and access privileges. Nothing to do with segregation of duties, more to do with ensuring passwords to the right people and access privileges for certain people. For example, approval process can only be accessed by the manager or the CFO. So it's probably not going to be that one because it doesn't fit into the context here. Next one is organizational and management control. So that is to do with hierarchies and segregation of control. So we talked about that up here. So it's to do with the structure of the organization, segregating incompatible functions like developer and user. So that's most likely the answer there, C. And then just to check off D just in case. So systems development and program maintenance control. So that's this one here in the list. Systems development and program maintenance, which is about compliance to standards, even with the update, and also changes to the program. But that's not what the context is talking about. So clearly the answer is C, organizational and management control. Okay, next question. With respect to financial statement fraud, which one of the following statements is not correct? So not correct. So A, inquiries of management are more useful for detecting management fraud than employee fraud. B, the auditor must consider the risk of material fraud at both the financial statement level and the assertion level. C, excessive pressure on management to meet expectations of third party creates incentives for management fraud. And D, the auditor needs to consider the likelihood of collusion in determining the appropriate level to report suspicions of fraud. Okay, so because this question is all about fraud, how I would approach this is I would do a Control F in the notes to get to the relevant section talking about fraud risk. So if we do that now, it'll bring us up to 2.6, which is risk assessments for specific matters, and then sub-point fraud risk. So ISA 240 is the relevant section requiring auditors to consider risk of material misstatement due to fraud. And the engagement team must discuss susceptibility due to fraud or error. So we also know that the auditor is required to ask management, i.e. those charged with governance, i.e. the board, and the internal auditor about their assessment of ROMM due to fraud, procedures carried out for identifying fraud, their knowledge of actual or suspected or alleged fraud, factors to be considered in management's own assessment of fraud. And then also, you'll note here, ISA 240, paragraph A16 recognizes that inquiries of management may be useful in detecting employee fraud, but of limited value in detecting management fraud. And this is why inquiries are also to be sought from others within the entity. And in general, there are also benefits of obtaining evidence outside the control of management for the potential existence of fraud. For example, external evidence related to airline flights may be available from airports or trips made by trucking companies. Okay, so the key point here is that management may be useful in detecting employee fraud. So you can ask management about do you think there's fraud by like your senior accountant or your senior payroll officer. But it's not a lot of value if management itself is committing fraud, which makes sense because if they're going to commit fraud, they're going to tell you the wrong thing. They're not going to bring it up to your attention. They might make excuses for things going on, and they have power. So they have power to intimidate people. They have power to hide things. They have the power to cover up things. So it's a one-way look for fraud in the lower levels of the company, but we're not good for identifying fraud within management. And therefore, that's why it's important to look outside of the organization to substantiate, what management is saying, and also just check for fraud at that level as well. So let's see if any of that helps with our possible answers here. So the first one here is inquiries of management are more useful to detecting fraud than employee fraud. Well, we just went through this and we said that inquiries of management is good for identifying junior level employee fraud, like i.e. not management, but if it's not good for identifying management fraud. So what this is saying is the opposite of that. It's saying that inquiries of management is useful for detecting management fraud. That's not correct. It's the opposite. It's useful for detecting junior level fraud, right? Employee fraud. So this one is not correct, but because the question is asking us for the not correct answer, this one is most likely going to be the correct answer. But let's just double check these other ones as well. So B, the auditor must consider the risk of material fraud at both the financial statement and at the assertion level. I mean, that's correct. What else? The excessive pressure on management to meet expectations of third parties creates incentives for management fraud. That's correct as well. We discussed that when we went through fraud in the core content. And then D, the auditor needs to consider the likelihood of collusion and determine the appropriate level of report suspicions of fraud, which is also correct, and the reason why we need to go outside of the organization sometimes to get an independent view, just in case the information we're relying on from internal management is false, or potentially they're colluding with someone else in the organization, and therefore we can't rely on either of them or cross-reference what they're saying, so we need to go outside the organization. So clearly B, C, and D are all correct answers, but we're looking for the non-correct answer, which is this one. So that's correct. Okay, next question. Which of the following are financial statement frauds? A, forging of accounting records. B, unintentional omission from financial statement of transactions. C, intentional misapplication of accounting principles relating to amounts. Or D, intentional misapplication of accounting principles relating to disclosure. So the possible solutions are, actually, you know what we'll do is we'll just go through each of these items and we'll figure out if this is financial statement fraud or not, and then we'll just choose the corresponding answer down here. Okay, so for this one we just need to quickly define what financial statement fraud is. All we have to do is basically scroll down a little bit from where we were in the notes. We get to types of fraud, you get to financial reporting fraud, because I guess there's another type of fraud which is misappropriation of assets. That's just when you literally steal something, right? Maybe you steal cash or something. But financial reporting fraud is when you actually manipulate what's being reported, right? Maybe you're overstating sales, or maybe you're omitting something important, or maybe you're misrepresenting something that's important which isn't, and make it seem unimportant, right? So let's just do a quick recap in the notes. So financial reporting fraud is defined as ISA 40 as intentional misstatements, including omissions or amounts or disclosures in financial statements to deceive financial statement users, which can be accomplished by manipulation, including forgery or alteration of accounting records, or misrepresentation, which is intentional omission from the financial statements of events, transactions, or other significant information. And then C is intentional misapplication, which of applicating principles relating to amounts, classifications, manner of representation, or disclosure. So this can commonly involve changing accounting estimates to get a beneficial result, incorrect choice of accounting policy to get a better result, or other activities to create a picture that is misleading. Okay, cool. So let's have a look at this. So first one, forging of accounting records. So that would be accomplished by manipulation, which was specifically mentioned to include forgery. So that one would be an example of fraud. Number two is unintentional omission from financial statements of transactions. So that would be misrepresentation, which would include omission of, unintentional omission. So I thought they said intentional, because intentional is a very important indicator of misrepresentation. If it is an accident, it doesn't count as fraud. It must be intentional. So this would not constitute financial statement fraud. Three, intentional, so that's good. Misapplication of accounting principles relating to amounts. Again, that would fall under this one. So it's intentional. If it was unintentional, it wouldn't count, but if it's intentional, it would. Misapplication of accounting principles, so that would also constitute financial statements fraud. And then 4, intentional misapplication of accounting principles, same thing there as this one here. So clearly, examples of fraud is 1, 3, and 4, not 2, because I was unintentional. So the one that says 1, 3, and 4 is C. Done. There we go. Correct answer. All right, next question. Which of the following statements about fraud is correct? A, fraud can be intentional or unintentional. That's not right, because we know that it must be intentional. B, fraud always involves misappropriation of assets. That's not true either, because we know that it could be a financial reporting fraud, right? C is fraud always involves the use of deception to obtain an unjust or illegal advantage. I mean, that's most likely the correct answer, because it's deliberate deception in order to obtain an unjust or illegal advantage. So most likely that's correct. And then finally, D, fraud is always perpetrated by management, those charged with governance, or employees. It could also be perpetrated by external parties as well. It doesn't necessarily just need to be by someone working for the organization or employed in some form, or managing that company, right? For example, a supplier could send fake invoices, and if the company doesn't know and pays it for work not done, that will constitute fraud, right? So we know A, B, and D are definitely examples of fraud. C, we thought was most likely the correct answer, but let's go with that, and it is correct answer. Cool. Done. Next question. Okay, you are the auditor of Client Co. and have commenced planning for the 2019 or X9 audit engagement. As part of your planning activities, you have asked the CEO about important events during the year that might have an impact on the audit. In response, he's asked you to take it easy on the CFO because his son is seriously ill. Apparently, the child must travel regularly to the United States for expensive medical treatments. What fraud risk factors are present in this situation? So just as a quick recap about this, so generally as auditors, we follow this principle called the fraud triangle. Is there are three key indicators when they exist, fraud generally exists, or there's a high chance of it occurring. So number one is incentive, i.e. incentive or pressure. So for example, if you've got financial pressure, for example, in that situation, this guy had a sick child, which is very expensive. He had the incentive to commit fraud because he needed the money to help his child. That's incentive. A perceived opportunity to commit fraud, for example, if there's weak internal controls. I mean, he's in a position of power. He'd be able to override controls, for example, because of that hierarchy. He'd have access to a lot of confidential information, and he'd have the background, experience, education to be able to cover it up fairly effectively. So there's definitely an opportunity there. And then finally, being able to rationalize, make excuses in their mind. Well, I mean, his son's life is the most important thing to him. So even though fraud is a bad thing, in his mind, his son dying is probably a worse thing. So in that sense, he probably had to rationalize committing fraud because it's a means to justifying this other more important thing. So most likely all three of those are present, and therefore there's a very high chance that fraud exists as a result of the fraud triangle concept. So as we went through, there's definitely examples of all three elements of the fraud risk triangle being present, which is incentive, opportunity, and rationalization. Therefore, D is most likely the correct answer, and it is. Cool. Next question. Which of the following best describes the auditor's responsibilities in evaluating the appropriateness of the going concern basis of accounting? A, the auditor's responsibility to consider the going concern basis of accounting only when potential problems appear. B, the auditor should evaluate management's assessment of the appropriateness of the going concern basis of accounting. C, the auditor should collect information and make their own evaluation of the appropriateness of the going concern basis of accounting. Or D, the auditor should ask management about its plan to deal with problems relating to the business's ability to continue as a going concern. Alright, how I would approach this one is just do a Control F and go to going concern section of the notes. That will take you to this part here. In the notes, going concern risk 129. So the key points here which we can recap is, and of course red means important point. So going concern is obviously the entity's ability to continue operating in future. And as part of the planning process, the auditor need to consider whether there are any events or conditions that may cast doubt on that entity's ability. Because that's, if not the most important thing, it's one of the most important things for a shareholder to know about the business. If it's not likely that the business will be around in 5 years, that's something the shareholder should know. So the auditor needs to review management's risk assessment to determine whether it has identified events or conditions that may cast significant doubt on the entity's ability to continue as a going concern and evaluate management's plan to address them. So if you break that down to a few key points, it's review management's assessment of going concern, and then separately determine whether it has identified events or conditions that may cast doubt on that going concern. And then thirdly, evaluate the plan to address them. So which of these possible answers most closely fits that? And they're quite similarly wording, so we need to really figure out what the key point is behind each of these. So the auditor's responsibility is to consider the going concern basis of accounting only when potential problems appear. That's not what the note says. The note said that the auditor always needs to review the management assessment. So that's not correct because it's not dependent on problems appearing. You need to know always. B, the auditor should evaluate management's assessment of the appropriateness of the going concern basis of accounting. Yeah, I mean, it's relatively correct. I mean, that's what the notes are saying. It says we need to review the management's assessment of risk. I mean, the full response might say something a little bit longer, but I think that captures the essence of it. So for now, that's the most correct answer. C, the auditor should collect information and make their own evaluation of the appropriateness of the going concern basis of accounting. Again, that doesn't fit in with what we were saying here. We need to review management's assessment, not make our own assessment, and consider whether they've identified everything and then evaluate their plan. So C is not correct. And then D, the auditor should ask management about its plans to deal with problems relating to the business's ability to continue as a going concern. I mean, that was mentioned in the notes, but it doesn't really capture the crux of the point. The crux of the point is, number one, review management's assessment and then evaluate it and any concerns it's raised from that assessment. So to identify the problems, you need to have assessed management's risk assessment on going concern, which this point doesn't mention at all. I think the most correct answer here is therefore B, and that's the correct answer. Okay, cool. All right, next question is ISA 240. The auditor's responsibility relating to fraud in an audit of financial statements specifically requires the auditor, when identifying and assessing the risk of material misstatements due to fraud, to presume there is a risk of fraud in A, revenue recognition, B, weak internal controls, C, liability understatement, or D, misappropriation of assets. So you might already know the answer from context based on watching the core content videos. The other way to do it, if you're not quite sure, which hopefully you know the answer already, but if not, that's fine. What you can do is you can do a Control F based off risk of fraud. And there should only be so many few examples of this in the notes. So let's go ahead and do that and type risk of fraud into Control F. Let me show you what pops up. So over here, you can see there's only a couple of examples, and you can kind of see a preview of each point. So risk of fraud or error, nothing really there. Risk of fraud in revenue recognition. So this is an important point which falls under fraud risk. So that management should presume the risk of fraud in revenue recognition. So basically what that means is, even if even if it's a pretty good company, like you're auditing Apple or whatever, you should just automatically assume that there is risk of fraud until you've proved otherwise that there isn't. So the answer is A, revenue recognition. Cool. All right, next question. You are considering the work of the internal auditors of ABC Limited. Which of the following facts identified in the review of the internal audit function will give you confidence that the internal auditor is technically competent? A, the head of internal audit has a direct reporting line to the audit committee. B, the head of the internal audit is free from the influences of operational management. C, the head of internal audit is a professionally trained auditor and a member of the Institute of Internal Auditors. And D, the internal audit function regularly examines controls over all the significant accounting operations that affect the financial statements. So how I'd approach this question is I'd look up the section on internal audit in our notes relating to page 211. So bring that up. So basically the key points here is when you want to rely on an internal auditor's work, you need to do an evaluation of the internal audit's functions. So the three things here: organizational status and relevant policies and procedures, right? So this is basically how important the organization views this, how much power they have, do they have policies and procedures in place to ensure effective controls in the organization, things like that. B, levels of competence. So the people in the internal audit division, do they have professional training? Do they have relevant qualifications? What's their skill level, right? And then finally, application of a systematic and disciplined approach. So linking that back to what's in these questions, so which of these points will give us confidence that the internal audit is technically competent, right? And that kind of links into that second point here, level of competence. Technical competence is more around professional training, relevant qualifications, memberships, things like that, right? So A, the head of internal audit has a direct reporting line to the committee. This could be a trick question because, if the question was more generically about, which of the factors would give us confidence in the internal audit function, full stop. But, that might relate to this, the organizational status, because if they've got direct reporting line to the audit committee, that means they've got a high organizational status potentially. But the trick is this question is asking us specifically about the second point, which is the internal auditor's technical competence. So just remember that we have to follow the question exactly, right? So that's a bit of a trick question. So it's correct in some sense, but not correct because the question is specifically asking us about technical competence. So B, the head of internal audit is free from the influences of operational management. Again, probably more to do with this organizational status rather than technical competence. C, the head of the internal audit is professional trained auditor. Yep, that's a tick. And a member of the Institute of Internal Auditors. So that would lend itself to the second point, level of competence, because of their professional training, relevant qualifications, etc. So this is most likely the correct answer here. And then D, the internal audit function regularly examines controls over the significant accounting operations that affect the financial statements. I mean, that's probably relating to this fourth point, application of a systematic and disciplined approach. So I mean, they're all correct in their own way, but the only one that actually links into internal competencies is this one here, C. And that's the correct answer. Cool. All right, next question. Which of the following computer-aided audit techniques is not useful for substantive testing of transactions and balances? A, test data, B, utility programs, C, specialized audit software, or D, generalized audit software. So first of all, we just need to remember what substantive testing is, or you might have seen it as SAP, Substantive Analytical Procedures. So what substantive analytical procedures is, let me just bring up the notes, I'll show you a good example. So an SAP, I will call it, or substantive analytical procedures, are designed to substantiate financial statements balances by using predictable relationships. So what that means is, let's say you have a balance, right? For example, interest expense. Now, instead of adding up all the GL data, right, and looking at the transactions and doing it from the detail level and consolidating up, what an SAP is it starts from the biggest numbers, right? For example, interest expense, let's start with there. So what are the drivers of interest expense? It's the loan balance, the closing loan balance, or you could say the average loan balance throughout the year, times the interest rate. Okay, so you times the two together and you get, let's say it ends up being 30 million. That's a ballpark figure as to what you would expect the actual, once you add up detail, to be close to it. Now, it might not be perfect to the dollar. There might be like a small variance, like 1, 2, 3, maybe 4% variance, right? And maybe when you investigate, you can figure it out. Maybe it's because you're using an average interest rate or an average loan balance of the year, but once you actually add up the exact loan balance for each month and do the calc, it might remove that 5% or 4% variance. But as long as it's within an acceptable variance level, you're saying, okay, that's pretty close, good enough, right? So it just means if you do an SAP on certain accounts, especially the low risk accounts, and say, yep, that balance looks fairly close to what I expected using my SAP, then you don't need to do a lot more work on it. But if there's a large variance, you need to investigate. So here's an example here. We've identified interest expense as an account we want to look into. It's not a high risk account because it's not revenue, and it's not an account that we've identified as high risk for this particular business. So the audit partner says, yep, that's fine, we can just do an SAP. So what we're going to do is we're going to look at the loan balance for the last 2 years, so all 2018, 2019, take an average of the two, 31.02 million, and then we're going to times that by the interest rate, or we're going to times it by the average interest rate throughout the year. So we're saying it was between 3.21 and 3.15, so we're going to take an average of 3.18%. Therefore, we'd expect the interest balance to be around 31 million. Now, when we did the that we're expecting the interest expense to be around 986,000, right? And when we did the actual interest calculation, it came out to be 972. When we checked it against the client's closing total amount for the year, they came up with 972, which is a variance of 14k or 1%, which is very small variance. Once you take into account the actuals rather than just an average, you're probably going to get rid of that 1% down to close to 0%. So that variance we're saying is immaterial, therefore we don't need to do a lot more work on this account. We're relatively happy with it. And we can focus our limited time and efforts on the high risk accounts or the accounts with variances. So just going back to our question, let's keeping that in mind. So which one of these would not be useful for substantive testing? So generally with substantive testing, you just need high level data. For example, in that example I showed you before, we only used opening and closing loan balance and opening and closing interest rate. So it's not a lot of data, it's very high level and it's focused on drivers. This first one here, test data, that's going to be millions of transactions, right? That's more suited to the other type of audit procedure called test to detail. So test to detail is you request so instead of doing the high level, you're doing a deep dive into a very small amount of data. So it's not necessarily all of the data, but you take that small amount of data, do a lot of work on that small amount of data, and extrapolate it across the rest of the business. So if we take 5% of the business's data, we look at that, do a lot of work, and say, well, within that 5%, we found one error out of 1,000 entries. So we're going to apply that percentage across the rest of the business, the rest of the 95% as well, and say, so if we're going to say 95%, so basically we're going to say a very high level. So we said there's 1,000 entries, that's only 5% of the business, 0.5. So we reckon there's 20,000 transactions in the entire business with an error rate of 1 divided by 0.95. Oops, sorry. 1 divided by 0.05. So we think there's an error rate of 20 out of 20,000, low materiality. So this one, test data, will be more suited to a test of detail, right? Because it's a lot of data. We request that detail so we can look into the detail and do that, a lot of work on that, and then extrapolate across the rest of the business. If we were doing substantive testing, we would request just a couple of pieces of information, right? The interest rate, for example, the loan balance, basically the key drivers of a particular balance. So this one here doesn't really fit in with what's for a substantive testing. Now these other programs over here, utility programs, specialized audit software, generalized software. I mean, these are accounts that can be used, these are software that can be used for data access and manipulation, and you can do substantive testing based on these programs. For example, maybe it's a modeling program which takes a little bit of data and then extrapolates it across the business and then estimates what the closing balance is. So you can do that with utility programs, you can do that with specialized audit software and generalized audit software. So that's the logical way of approaching the question. You could also do it from do a control F of certain keywords. For example, utility program, looking for the more specific wording. We can hopefully find a match based on that. So if we do that in our notes, let's see what comes up. So it's going to take us to this page here, which is using CATs for substantive testing, which is relevant, so computed programs for substantive testing. So it's saying that substantive procedures can also be performed by the use of CATs, including you're looking for fluctuations or consistencies, sampling. So audit software may consist of generalized audit software, purpose-written programs, utility programs, and system management programs. So all of these can be used for substantive testing. Now, utility programs is mentioned there, specialized audit software, and generalized audit software are all listed in that subsection in the notes about using CATs for substantive testing. So clearly all of these can be used for substantive testing. This one is better suited for test of detail. If you're not quite sure still what the difference between test of detail and substantive analytical procedures, please watch the core content video up above. It's going to give you a little bit more extra background, which will help you approach questions like these a little bit easier. All right, so let's go ahead and lock that in. Clearly the right answer. And next question. So an underlying feature of random-based selection of items is that A, item must be systematically selected using replacement. B, an item in the accounting population be randomly ordered. C, an item in the accounting population should have an opportunity to be selected. And D, the stratum of the accounting population to be given equal representation in the sample. Okay, for this question, I would recommend just doing a control F of random or random based in the notes. So that's going to come up with the following section, which is talking about selection of a sample size. And sampling is important for when you're dealing with a lot of information. For example, you're doing a test of detail and you want to do a deep dive into a small data set of that population, maybe 5% of the total population. Because let's say you're doing with a bank, and a bank's got hundreds of billions of transactions, right? So obviously you can't audit and review every single one of those transactions. So what you do is you take a sample of that data, and then whatever your conclusion is based on that sample, you can extrapolate it across the rest of the business. So it's very important to choose a sample that is representative of the rest of the population, because the risk is you choose a 5% of the data set, and that is completely different to the rest of the business, right? So let's say your business, 90% of the transactions are similar to each other, 10% are completely random. What happens if you choose that 10%? Then what you're going to be working on is not representative of the rest of the business, and if you don't find any errors in there, but there's errors in the other stuff, then that's the perfect representation of audit risk, right? Because you're auditing something which isn't representative, and there is material misstatements and potentially fraud, but you haven't identified that, right? That's audit risk, which we talked about earlier. So anyway, I did a control F for random over here, so that's taken us to this section over here, which is selection of the sample size that you use for test of details, etc. So there's three main methods to allow a representative sample of the population to be selected. So number one, random selection. Number two, systematic. Number three, haphazard. So random selection is where each sampling unit making up the account balance has an opportunity of selection. So that's a key point, is no matter what the journal is or what the transaction is out of the billions and billions of transactions for the company you're auditing, every single one of those needs to have an opportunity that it could be selected. You can't say only these ones I'm going to choose from this month, right? And only use those ones. It's got to be, if you're going to do a true random selection population method, then you need to have an equal opportunity for, well, not an equal opportunity, but all journal entries need to have an option of being selected. And it also requires that the person selecting the sample does not influence or bias the selection either consciously or subconsciously. So that's why you need a program to do it, so it's just completely random. For example, you do the random function in Excel, you have no influence over what number can be selected from that. That way you know that it's got the best chance of that selection being most representative of the rest of the group. So let's see which one of the answers best reflects this equal opportunity or an opportunity of selection. So A, items must be systematically selected using replacement. Not really true, because we don't want it to be systematically selected, we want it to be randomly selected. B, items in the accounting population be randomly ordered. So I mean, that doesn't really matter if it's randomly ordered or not, because at the end of the day, the items that we're selecting are random. So as long as that criteria has been filled, then it doesn't really matter what order it is, because it's basically still random. C, item in the accounting population should have an opportunity to be selected. So this one is definitely true, because as we said before, all items need to have an opportunity of being selected. So, and then finally, stratum of the accounting population be given equal representation in the sample. So that's not true either. So clearly the answer is C, because all items need an equal chance of, need to have an opportunity of being selected. All right, next question. To obtain direct evidence that online access controls are properly functioning, an auditor is most likely to A, vouch a random sample of processed transactions to ensure proper authorization, B, enter invalid identification numbers or passwords to ascertain whether the system rejects them, C, create checkpoints at periodic intervals after live data processing to test for unauthorized use of the system, or D, examine the transaction log to discover whether any transactions were lost or entered twice because of a system malfunction. So this is a bit of a tricky question. It's tricky because it's going to be hard to find in the notes, and also it's quite a sophisticated question as well. The other thing to note here is it says direct evidence rather than indirect evidence. So direct evidence is when the auditor kind of gets that information themselves, right? Because whenever you have indirect evidence, you're relying on the fact that it worked for someone else. Same reason we don't like to rely on fraud internally, and we like to also correlate with that with external confirmation. That way allows us to kind of get some direct evidence of that as well, right? Because if you're doing indirect, you're relying on someone else, but that could be wrong for whatever reason, right? So it has to be direct, like we have to be testing it ourselves. So that's going to help us eliminate some of the answers, this direct part, right? Because vouching a random sample of processed transactions. Okay, wait, hold on, before we get to that, what are we trying to test? And what are we trying to get direct evidence of? We're trying to get evidence that the online access controls are properly functioning, right? So what that means is, for example, if we're entering, a data into the system, whether that's trying to get access to a confidential part of the system, like payroll, for example, let's try and access that ourselves. The online access controls would prevent someone who doesn't have the right access from accessing private payroll data. So how do we know it's working? Well, we can get indirect evidence, and we can talk to people and say, were you able to get evidence? Or maybe we can check the general ledger and look at the reports or the access history and see if anyone on that list shouldn't have rights access who can access it. That's an indirect way. But a direct way of checking this is for the auditor to just try and do it themselves. For example, why don't they log on, and if the auditor can access it, then clearly there's a control issue, right? But if the auditor cannot log on, there's some direct evidence that the control might be working, right? Obviously we have to do more tests, but that's a good sign, right? Anyway, let's go through these one by one. So the first one is vouch a random sample of processed transactions to assure proper authorization. So for example, I used the payroll example before. So this is quite similar. So it's taking a sample of transactions. So whether that's someone's being able to log on to the payroll module and journal some templates, or it's an access history log, whatever it is. Either way, you're getting that sample of data, you're checking it against a list of who should have proper authorization. So whilst this is a good check that the access controls are properly functioning, it's not a direct evidence, it's indirect evidence, okay? Now the second one is enter invalid identification numbers or passwords to ascertain whether the system rejects them. So that would be a good direct way of checking it, because the auditor, as I mentioned before, the auditor is checking it themselves. they're logging on, they're typing in the data. Right? So this one is probably the correct answer, but let's check the other ones just in case. C is create checkpoints at periodic intervals after live data processing to test for unauthorized use of the system. So with C and D, it's just the same as this one over here in the sense that, yes, these are probably fine to use as checks of online access controls, but they're still indirect because, for example, this one, they're not doing it themselves. They're still creating checkpoints and then referring to GL data for whether this is properly functioning. So it is an example, but it's just not direct evidence. And same with this one here. So examine the transaction log to examine whether any transactions were lost or entered twice, because so it's exactly the same as this one. Probably an OK check, but control check, but it's just not a direct. So clearly the only one that isn't indirect, or the only one who is direct, is this one here. So the auditor enters in this invalid identification numbers, live, or passwords to ascertain whether the system rejects them. So he just types in some random password, and if he can get in, then the control has failed. And if he can't get in, then it's evidence that the control might be working. So there we go. There's the correct answer. And look, I think that's enough questions now that you kind of got the idea for at least Module 2, how to use the notes, what's the approach to take, what's the logical process, how do we use deduction to figure out the right answer, and so forth. So it's really not too hard, as long as you have a good understanding of the fundamentals and you can kind of tie the concepts together, and then you know how to look within the notes for, and what kind of keywords you need to be looking for, and then using deduction to figure out the answer. I think you should be fine. But if you can, in your own time, just practice the rest of the questions for Module 2, and then by the time we end up finishing audit, and you've gone through all of the modules and can get them right, then you should be ready for your final exam. So anyway, thanks for watching. Hope you found this useful, and I'll see you in the next video.